From New York City, for our viewers worldwide, I'm Manus Cranny in for Jonathan Farrow. As you can see, there is a lack of belief from Morgan Stanley, JP Morgan and HSBC. Time to de-risk your equity trade 2024. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Coming up, markets are on the edge. Stocks and bonds resume their declines. Investors brace for key inflation figures and the start of the earnings season. Over on Capitol Hill, it gets back to work with a busy week ahead. We begin with the big issue. Prepare for higher for longer.
The risks are that the Fed's going to keep rates higher for longer.
Higher for longer.
Higher for longer interest rates.
The expectation is that the Fed will cut rates at some point. The question is when and by how much.
The risk would be those rate cuts get priced out because inflation kind of turns higher.
The markets are so wedded to this idea of dramatic cuts from the Fed.
It's the rate side that has gone a little bit too far, too fast.
They are not going to materialize, and I think summary pricings will come.
As that gets at least partially unwound, partially priced out, that leads to that reverse Goldilocks.
Or reverse Goldilocks.
Usually that kind of reverse Goldilocks environment is basically you can't buy anything.
We've been saying for quite some time that 4% is fair value.
It's really an environment now where it's not the classic risk off.
The early part of the rate cutting cycle will see yields fall.
What you are is more susceptible to gyrations in yields more than anything else.
Did you get the message? Reverse Goldilocks, she's in the building. Joining me now to put some context around that, Aberdeen's Luke Hickmore and Mike Kontopoulos of RB Advisors. Gentlemen, good morning. So we've now got a shift in the narrative across the houses. We're backing up in yield. Reverse Goldilocks is arriving. Mr. Hickmore, good morning. It's been a while. The temptation is to neutralise everything. How careful must I be not to throw baby out with the bathwater? Good morning.
Morning, Manus. What a pleasure it is to be on with you. I think the bears are eyeing up Goldilocks' dinner. And it's a real problem for investors who have had an amazing Christmas period. The run-up through to the end of Q4 was huge across all asset classes. It had clearly gone too far. This pullback seems incredibly sensible. Don't get caught up too much in this narrative, though. I think this is the year where you dollar cost average. You think about your positions. You want to be long duration, long investment grade credit, long banks, nervous about tech, and slowly average into those positions because the volatility otherwise is just going to wipe you out.
Okay, heresy, nervous about text, but maybe prescient. Let's take it across to Michael. Good morning. Good to have you with me. There you go. We say reverse Goldilocks is attempting to steal the porridge. You say it's time not to be a hero. Can you translate what that means, not to be a hero and take a lot of interest rate risk now? Does that translate to de-risk?
Yeah, Luke, I think there's a couple things that I would highlight. I mean, I would actually disagree, Manus, I just actually disagree with Luke a little bit with regards to his assessment. You know, we actually really don't like investment grade credit here. We don't really like duration here, as you mentioned. It's really not time to be a hero in either one of those two asset classes from our point of view, but for very different reasons. You know, credit spreads are incredibly tight. And I agree with, the intro here with many of your prior guests saying that, you know, the number of cuts priced for the first half of this year is pretty much way overdone. And in fact, what you're likely to see is a much stronger economy than the market expects. You're most likely to see a Fed that stays on hold for much longer than the market expects. And where's the pricing for the, another hike? We haven't seen that yet. And so I think things are going to have to get priced out pretty meaningfully. And in that world, you know, you look a lot more like 2022 than the last 2 months of 2023.
Well, 2022 was pretty bruising for risk. You can't throw a wrench in like, we haven't priced in the possibility of a rate hike. Do you really think that's even possible or on the table, or is it just higher for longer and rates delayed? Michael?
You know, I think you can absolutely have some probability assigned to another hike. I think the market has gotten way ahead of itself. I mean, inflation is still over 3% across the board, core and headline. And as you get closer to the summer, you may actually see inflation start heating up. You're seeing a number of inflation measures that are not coming down to the extent that the Fed would like them to. And if you hang out in the 3.5% range with unemployment at sub 4% and profits accelerating, why is the Fed just going to hold rates where they are?
Okay, let's take that over to Luke. I'm going to assume you're going to take the other side of that trade. I mean, there is a tail risk of another hike. Nobody's talking about it, but there you go. We got it on the table for Tuesday morning. Hickmore, do you take the other side of that trade?
Yeah, I do, but cautiously.
Okay.
Where I do agree with Mike is that things have moved into richer territory, but that's my point. You step in slowly during this market. You buy the dips. Use that from the technology teams. They've been buying the dips for years. Sell your tech, buy your bonds, but do it slowly.
Judicious deployment of capital. I think that's the phrase that most sales men and women would try and use to me at this juncture. I've got a meeting with somebody this week. I wonder what they'll tell me. Investors are digesting the latest Fed speak. They're bracing for Thursday's key print. On the inflation side, Mike McKee is with me to soothe the bond market's nerves. Will the print soothe the nerves? Mike, good morning.
That's an interesting question because, as we've discussed over the last couple of days, headline CPI is probably going to go up a little bit, core stay unchanged, and on a year-over-year basis go down. What happened yesterday was interesting, though, because Mickey Bowman, the Fed governor who's been the most hawkish on the Open Market Committee, said that if inflation keeps falling, rate cuts will eventually become appropriate. And people took that as a sign that the Fed is done raising rates. Raphael Bostic also spoke, the Atlanta Fed president, saying he sees 2 cuts this year, nothing like the 6 the market see, and the first one not till Q3, which brings up that higher for longer aspect of it. Now, one of the monkey's wrenches in, or I guess, Manus, we should say spanner in the works for you, is borrowing costs out there. Borrowing costs, you can see the yellow lines, that's the Goldman Sachs Financial Conditions Index, but borrowing costs have not significantly dropped. They are still fairly high, but if they follow the Financial Conditions Index down, then Mickey Bowman says we could have a problem. There's a risk that the recent easing in financial conditions encourages a reacceleration of growth, stalling the progress in lowering inflation or even causing inflation to reaccelerate. There's another risk too, Manus, and that is that even without borrowing rates falling, we might see problems. This is the consumer credit numbers that came out last night from the Fed. You can see over on the right-hand side a big jump in credit card spending in November. And the white line there is the credit card interest rate, the average interest rate. Went way up, still up, not coming down, but people are spending more money anyway. That's a recipe perhaps for overheating, and that makes the case for more Fed tightness. So at this point, it is really data dependent, and we don't necessarily know. I think they'll stand pat in January, but we don't necessarily know whether they're going to be cutting at the rate the market wants.
Okay, well, let's see what the CPI print is. Mike, thank you very much. A little bit later in the week, my guests this morning, Luke Hickmore and Mike Kontopoulos. So with the last chart that we showed, there was the New York Fed inflation expectations 1 year forward. Beautiful, beautiful ski. Just a beautiful, smooth run down. It's a bit like me on pair of skis. Not, I tell you, it always ends brutally, badly, and my friends go, we're never skiing with you again. So here we are, we're sub 2%. Are you convinced that this has been vanquished? Inflation has been vanquished, or is there a risk that it repops? Mike?
Yeah, I think there's absolutely risk here. I mean, look at the NFIB small business pricing plans, which tend to lead inflation. They've reaccelerated for a number of months, notwithstanding a little, notwithstanding a little bit of a dip over the last month. But you look at that chart over the last day, and it doesn't tell good things about the where inflation is going. And so rental inflation is not coming down like folks expect. And so as you look at sort of the real core measures of inflationary pressures, they're not coming down to the extent that people think they are. And then you couple that with a profit story that is quite favorable. We expect profit growth to accelerate towards mid-teens by end of Q2. And why are companies going to start firing in that environment? And so wage growth is going to continue to remain somewhat elevated. that's not a recipe for drastically falling inflation in our view. So I think you're going to get some surprises to the upside, and the market's really going to have to reprice things here. Okay, and Mike, you're going to have to bear with me. I'm going to have to give Hickmore a question for his own audience. I got PIMCO on a little bit later on, Mike, Luke, and looking at the 20-year bond auction this morning, record demand. That's what you call munching on duration. Would you be a buyer of UK gilts? PIMCO see opportunities outside of the United States of America. Do you want to feast on a few gilts, or are you worried about the vigilantes later in the year in the UK?
I want to see that 4% yield in gilts as well, to be fair. I think we're a little bit off yet from re-entering that market. My clients are short, our clients are a little bit short duration versus their benchmarks, all short in an absolute sense. I think the vigilante point's a really fair one, and this is around the idiot premium that Liz Truss left us with after a mini budget a year and a half ago now. That's still with us, and the theory's been that whoever wins the election is constrained by the bond market, constrained about how much they can borrow and how much they can spend. The bond market has already told them, let's not be silly with it. I think actually the parties are listening to that. I'd be really surprised if we get to the election at some point this year and they decided to throw the baby out with the bathwater and blow up the gilt market again.
Well, I'm excited to be here for one election cycle anyway. Luke, stay with us. Mike, we'll get back to you in just a moment. Mike Kontopoulos there and Luke Hickmore joining me now on the stocks move ahead of the opening bell. Abigail Doolittle is side by side with me. What have we got, Abby?
Well, Manus, we do, of course, have futures drifting to the downside. So weighing this morning are, among them, Netflix. Shares are down. This is Citi cuts the streaming company to neutral, and lofty expectations and upcoming risks equaling revenue estimates looking, quote unquote, a tad too high. JetBlue is also down nearly 5%. This is CEO Robin Hayes yesterday announced that he's stepping down. He's to be replaced by Joanna Garrity, the current president. Hayes is citing uncertainties for the company, health and family. But we do have a big winner, and that is Juniper Networks, up nearly 22%, soaring in a report that Hewlett-Packard Enterprises is in advanced talks to buy the company for about $13 billion. It could potentially help them navigate the AI scene. And this deal could be announced officially as soon as this week, Manus.
Yeah, we're getting a few deals come through in pharma and in tech, so it could be the year of the deal returning. Investment bankers of the world unite. Your bonus is getting made as we speak. Abigail, thank you very much. Coming up on the show, Secretary Blinken visits the Middle East amid rising tensions.
It's clearly not in the interest of anyone, Israel, Lebanon, Hezbollah, for that matter, to see this escalate and to see an actual conflict.
Geopolitical risk and markets. That's part of the conversation next on Bloomberg.
It's clearly not in the interest of anyone, Israel, Lebanon, Hezbollah, for that matter, to see this escalate and to see an actual conflict. We've had 40 countries come together to make clear that what the Houthis are doing has to stop, and we have other countries that have made clear that if it continues, there have to be consequences. So, our strong view, our strong preference, is that the Houthis get the message that they're receiving from countries around the world that this needs to stop, and that's what we're focused on.
And these tensions are escalating further after a drone strike in Lebanon. An Israeli drone hitting a car, killing 3 people. That's just one day after a similar attack killed a Hezbollah commander. The Secretary of State, Antony Blinken, there meets with the Israeli Prime Minister Netanyahu and other top officials. This is day 4 of his trip to the region since October, as the White House tries to avoid broader conflict. Blinken saying earlier in the week, quote, this conflict could easily metastasize. Bloomberg's Kayleigh Lyons is tracking this story. He's touching down there. This is a whirlwind tour. Kayleigh, what do we expect in terms of progress of the narrative from him? What will be the key message coming from the Netanyahu meeting?
Well, Manus, the message is likely to be very consistent with what the U.S. and the Biden administration has been saying for some time now, which is that they would like a de-escalation in the conflict between Israel and Hamas. It's war that is taking a massive toll on Palestinian life in Gaza and pressuring the U.S. very much so at home. President Biden, when speaking in South Carolina yesterday, actually had his speech interrupted by protesters chanting "ceasefire now," to which the president responded that he understood their passion, and he's been quietly working with the Israeli government to get them to reduce and significantly get out of Gaza. And that is the work that we expect Blinken is continuing as he meets with Netanyahu and other top Israeli officials today. But that really is just one part of this equation, Manus. On the one hand, yes, it is about the conflict between Israel and Hamas, but also the U.S.'s desire to not have that conflict spread into something much broader regionally, especially as you were alluding to. Developments in recent days, the Hezbollah commander that was killed by an IDF strike yesterday. And now Reuters actually reporting today that Hezbollah in turn has attacked an Israeli army base with explosive drones. And that follows Blinken saying that it is in nobody's interest for an escalation in the conflict between Israel and Hezbollah, which is, of course, one of those important Iranian proxies, as is Hamas and the Houthis as well. And that is another issue that the secretary is having to grapple with. What's happening in the Red Sea, the disruptions caused by Houthi attacks on ships. Blinken warned yesterday of consequences for Houthi militants if they continue the attacks, which raises the specter of potentially more offensive action from the U.S. and its coalition of forces it's working with, rather than just the defensive measures we're currently seeing.
Kayleigh, thank you very much. Kayleigh Lyons there tracking Antony Blinken's trip around the Middle East. My guests this morning, Luke Hickmore and Mike Kontopoulos, are still with me. If I'm to be brutal in the analytic, there is no war premium across these asset classes. And that is because until it's in your own backyard, it doesn't matter to markets. Luke Hickmore, how folly is this of markets? A distant war in a distant land remains a material low risk to markets.
I actually think it's on every investor's minds. We all know this is the year of the election, and not just the big one in the US. There's 40 of them across developed markets, emerging markets. We're going to see them hit us again and again and again. We all know about political risk this year. Geopolitical risk has been in our face for the last 2 years. I think there is some exhaustion from the market about pricing that in. But we've also seen a reaction from things like freight rates. GTV, great function on Bloomberg. This morning had a brilliant chart on how freight rates on shipping are just starting to creep back up again. We've seen this come through in inflation, and everybody's got to be worried about that again. And I agree with Michael in this sense that we could see inflation come back, and it could be easily caused by all of the after effects, all the side effects of all these conflicts that are happening.
So with that in mind, Mike, is that what is in the back of the market's mind, but just not priced? That's not what's shifting bond and credit prices right now, is it? It's about fiscal and it's about supply.
Yeah, I think that's right. This is the bond market's definitely not pricing in much geopolitical risk. Listen, I don't think there's really much of a way to do that, right? You have to play the cards you're given. And right now, you know, the fiscal and the supply pictures are what are the knowns, and that's of course what the market's going to trade on. And so we'll see if that changes over the course of 2024. But I honestly think that's probably the right way to be trading the bond market and the equity market for that matter.
Okay, let's set you up. Let's give you the score on this one. You say, Mike, we're going to go through a slow-moving credit crisis. When people say the words credit crisis to me, I kind of asphyxiate because it brings back horrible memories to me. What kind of credit crisis are we going to have? And then, Hickmore, don't think that you're getting off the hook because you also have a view on where we go with the banks as a consequence. So the pro quo, Mike, first of all, what kind of credit crisis am I going to get? And is it going to be as bad as 2008?
Yeah, no, absolutely not as bad as 2008. So crisis maybe is too strong of a word here. And I also don't think it materializes over the next couple quarters. But I don't think there's any doubt in our mind that, listen, at some point, higher interest rates are going to bite corporates pretty hard. Spreads are incredibly tight right now and not compensating you for that risk. And so as we look out towards the second half of 2024 and into 2025, as refinancings go up quite a bit, particularly in high yield, we think that's going to bite pretty hard, and you're going to see many more defaults. But again, that's not a first half 2024 story, and that's why it's really slow moving at this point.
Very briefly before I go back to Luke, is there a kind of a level on high yield or investment grade on the blowout in spreads that you would seek to re-enter?
You know, it's hard to say that. I mean, we tend to be, although we care about level, of course, we tend to invest more on what's happening in the macro backdrop than just on the level itself. And so, I mean, certainly if you get north of 165, 170 basis points in IG and north of 650, 700 basis points in high yield, those levels are incredibly attractive. But, a lot will depend on what's going on in the macro environment as well.
Okay, in just over a minute, Mr. Hickmore, you have a proclivity for bank debt, not the equity. You're shifting a bit. With the landscape that Mike has just outlined, do I just leave bank debt and equity alone in totality? There you go. 13 years, you've had a strong opinion on on not buying the equity, but going towards a little bit of frisky CoCos and AT1s. And I know you were scathed in Credit Suisse. You weren't the only one. So how do you look at banks? Briefly, in a minute.
Banks are cheap. I think UK banks in particular are very cheap. They trade on ridiculous forward price to books. Barclays at 4 times should be on 8 times. UK consumers actually in a pretty good place. Look at the US. Look at what's been going on with credit cards. Morgan Stanley's up 30% in the last 6 months. Barclays is barely changed. I think there's some real opportunities there for investors to get on board with bank debt now, slowly building up into their portfolios. And you could be looking at 20, 30% returns rather than a 10 or 11% return on your CoCo AT1s.
In 15 seconds then, I take it you're not seeing a slow-moving credit crisis?
Absolutely not. I'd be buying investment grade on dips. I wouldn't buy yield.
You two boys can come back again. There you go. You got a bid and an offer. It's the immaculate market. It's the bid and the offer and everything. You can give one another a call and do an OTC trade. Luke, thank you very much. Luke Hickmore, good to speak to you again. Mike Kontopoulos, my guest this morning, dissecting the markets, credit and rates. Coming up, your morning calls. PIMCO's Tiffany Wilding will join me a little bit later. She'll make her case on the bond market for 2024. That's ahead of the opening bell, her cyclical outlook. Looking forward to that right here on Bloomberg. Time for your morning calls and look at some of the analyst recommendations on Wall Street today. First up, Citigroup downgrades Netflix to neutral, citing lofty expectations and a series of upcoming risks. Bank of America upgrading United Airlines to a buy from underperform, highlighting favorable valuation and strong balance sheet. And finally, Morgan Stanley downgrades PayPal to equal weight, noting slower than expected progress on key strategic initiatives. Coming up, PIMCO's Tiffany Wilding joins me to unveil her cyclical outlook for the year ahead. There are opportunities beyond the American borders, according to Tiffany. We'll run through what they are and whether that includes the gilt market right here on Bloomberg. Good morning. This is Countdown to the Open. I'm Manus Cranny in for Jonathan Ferro. We're moments away from the start of cash trading. The confidence in that small tech rally that you had yesterday seems to have dissipated. And as for breadth, well, the Russell 2000 down 1.45%. So this is about a mounting wariness from the analysts across the market. Morgan Stanley, HSBC, we've just had a couple of guests there saying, be careful in terms of taking equity risk. There is the opening bell. Let's roll it over. Have a look at some of the cash prices for you. We'll see what the rest of the assets are doing this morning. You've got the euro dollar flat at 109.44. 10-year yields, fair value. Well, Bill Gross doesn't think it's fair value at 4%, that's for sure. He'd far rather have tips at 1.8%. You're going to see a further backup in yield. We've just had a conversation about the risk for a slow-moving credit crisis. That may well come. Not a car crash like 2008, but risk is there. Oil bounces 1.72%. Anthony Blinken touches down in the Middle East on his Herculean tour. One stop to watch, it's Boeing. The plane maker's continuing fallout. This is loose bolts being found on the 737 MAX 9 jets that are being inspected as we speak. Abigail Doolittle has the details. What have they found, Abby?
Well, it's hard, Manus, to believe that this could all come down to 4 bolts, but that's exactly the case. Investigators right now are looking for 4 missing bolts. These are the bolts that would hold that door plug into the side of the plane so that it would stay on the side of the plane and the plane would stay pressurized, as opposed to that door plug blowing out and the depressurization and the horrors that the people on that plane suffered for about 30 minutes before it thankfully landed safely. Now, Alaska Airlines and United have found 737 MAX 9 planes, other planes that have been grounded, because of course the FAA over the weekend did ground 171 of those planes. Missing bolts. There was a missing washer in India. On this particular plane, it was basically brand new, 2 months old. There was also a pressurization fail light that had lit up 3 times. So it wasn't allowed to fly long distance. A Bloomberg scoop, the plane had Wi-Fi installed after the fact. So it seems like there were some issues for this plane. As for Boeing, this stock is down again. It could get worse for them if the FAA does, in fact, ground all of the other 737 MAX aircraft, such as the 8 that were involved in the 2018-2019 tragedies. This really puts clearly a stall in their turnaround beyond the apprehension that you and I, the average civilian, might have about getting on one of these planes. Ryanair CEO Michael O'Leary said Boeing has to improve their quality control. As for the stock, it is again down today. Yesterday, the worst day since October of 2022, falling 8% on the year, down more than 10% since its all-time high, Manus. This stock is still down about 50%.
Yeah, some big challenges for the CEO, I would say, Abby. That is going to be the next iteration in this story. Abigail Doolittle on the Boeing woes. Let's turn our attention to M&A. Wall Street Journal reports that Juniper was in advanced talks to be sold to HPE. Simone Foxman is here with the details. Run us through them, Simone.
Yeah, Manus, journal sources saying this deal could value Juniper Networks at $13 billion. That's a pretty big deal for Hewlett-Packard Enterprises, which, as of last close, had a market cap of just $23 billion. HPE, cloud services provider, it was spun off of HP, the computer and printer maker, back in 2015. And its revenue growth has really plateaued over the last couple of years at about 2%. November, in last earnings call, said it reported a steeper than expected decline in some of its server sales. Juniper also far from its flaming days of the tech bubble, down 80% since hitting a high in 2000. It makes routers and switches that direct information across the internet and sells the likes of Amazon, Microsoft, also AT&T. The whole deal, though, really focused around artificial intelligence. Juniper has an artificial intelligence business called Mist AI, and that's seemingly where HPE wants to get in. Bank of America says this would actually deviate from HPE's overall strategy, which has really been towards a services model. This would be potentially a little bit more into the hardware space, but it does have some merits: access to new consumers, bigger footprint in networking. And Bloomberg Intelligence, despite the size of this deal, says it's not likely to affect HPE's overall investment grade rating. That said, we are seeing the shares react this morning. Juniper Networks up over 22%, while Hewlett-Packard feeling the sting, down over 7% in today's trading, Manus.
Yeah, chunk of change out of that, over 7% lower. Simone, thank you very much. Let's turn to the world of dating apps. The Journal reports that an activist investor, Elliott, has built up a stake of $1 billion in Match Group. Alex Semenova joins me now. $1 billion for love.
Hey, Manus, good morning. Well, it is certainly a good day for Match Group, which is the parent company of Tinder and other online dating platforms. Shares are on pace for their best day since November 2022. This is after the Wall Street Journal reported that Elliott Management built a $1 billion stake in the company. Elliott is set to push Match to take steps to boost its stock price. That's according to the report, which cites people familiar with the matter. Aside from that, Elliott's specific demands, like whether it plans to revamp its board, were not immediately clear. The activist investment firm is, of course, known for taking stakes in beaten down companies and vying for changes to boost shareholder value. That makes Match, dare I say it, the perfect match for Elliott, given the fact that the stock was down 14% last year amid competition in the online dating space and struggled to retain users. The positive reaction, too, is no surprise today, given Elliott's track record. Elliott has engaged with about 60 companies since 2020, and 1 year later, most of those stocks were were higher. That's according to Bloomberg data. Analysts at Piper Sandler said that driving up revenue growth and free cash flow growth are among top of the list of possible items for Elliott. And they said that wouldn't hurt to have an extra pair of eyes on Tinder. Manus?
There you go. The price of love, $1 billion and an opportunity. The question is, are we going to see a price-cutting war for premium access and a swipe? Alex, thank you very much. Turn to the customers now, the consumer. How is the consumer? Urban Outfitters rising. That's after November and December net sales increased 10%. Katie Greifeld has more. Yesterday, Lululemon. Today, you're all about the retail now, Katie. How are you?
All about the retail. Well, that's because it's a big week for retail. Of course, we have the ICR conference this week. That's why we keep hearing from these retailers. We heard from Lululemon and Abercrombie yesterday, both of those chains lifting their outlook. And the party continues today with Urban Outfitters. The news there, we have shares rallying right now. The company said yesterday afternoon that same-store sales at Free People and Anthropologie, those are two brands under Urban Outfitters, they jumped by 20% and 14% respectively. Now, that was enough to offset weakness at the namesake Urban Outfitters brand that posted a 13% drop in same-store sales. You add it all together, and November and December net sales increased 10% versus those two months the prior year. So you put it together, and this is good news for Urban Outfitter, and that is definitely the thought process behind this Bank of America price target upgrade that we saw, lifting the price target to $45 from $42. The analysts there see further margin expansion potential for the company after, quote, a strong holiday. You take a look at shares right now, they're currently up almost 16%, or rather 6%. That would be its best day since about May or so, Manus.
I think my days at Urban Outfitters are over. I'm much more kind of like Paul Smith, slightly tailored and slightly more aged. Katie, thank you very much. Katie Greifeld there with the very latest on Urban Outfitters. PIMCO's Tiffany Wilding is in the wings as we start the new year writing this. The global economic outlook still clouded, and equity markets are priced for a soft landing. Bonds offer attractive yields and resilience across multiple possible outcomes. Tiffany joins us now. Weigh in. Good morning, Tiffany. Good to see you. These bond markets have been shaken a little bit. We're above 4%. I hear the supply issues you raised in the autumn time. Bill Gross doesn't think that they offer value at this point. On sovereigns in the US at around the 4.25%, do you want to scale back into this kind of sovereign debt at these kind of levels? Good morning.
Well, good morning. Thanks for having me. Yeah, I mean, so we think for longer-term investors, the bond market still provides a lot of value. If you look at high-quality credit, securitized markets, you're still getting relatively elevated yields, especially if you think, as we do, that ultimately the underlying neutral interest rate in the U.S. economy, is probably still around 0 to 2% on a real basis. And if we compare that to longer-dated real yields, for example, they're still elevated, but nevertheless, and this is where it's important to have, an active bond manager, nevertheless, when we look at, the front end of the interest rate curve, the Fed funds futures strip, we do notice that there's a lot that's already priced in terms of central bank cuts just in the near term. So I think, over the longer term, bonds provide value kind of as a tactical trading perspective, though, the bond market's priced in a lot in terms of cuts.
And to a certain extent, we've discussed that now for 6-7 days in a row. We've seen this retracement. You titled your piece at the start of this year, Navigating the Descent, and I'm curious the kind of rate cuts and the rationale for rate cuts this year. You've looked at history, and you talk about rate cutting in recession-like environments and rate cutting in non-recessionary environments, the 1995 style soft landing. So what will we get from the Fed, 3 or 6, or something a little bit even more muted than the 3 that the market has priced in?
Yeah, well, what we find when we look historically is that central banks tend to lag in their cuts. In other words, they don't start cutting until they're pretty certain that their economies are in recession. Now, nevertheless, and then when they do cut, they cut much more than what the market's priced in or what forecasters are expecting. Now, nevertheless, there's a handful of cycles historically, where central banks have managed to cut without an impending recession. In those, quote, soft landing cutting cycles, on average, the central banks tend to be cutting about 200 basis points. So that's, in the first year after the cuts start. So that's about twice the pace than what's currently in the SEP, for example, than what Federal Reserve officials expect. Overall, when we take a look at it, we think it's a reasonable baseline to think that probably the Fed is going to be a little bit more delayed than what the markets are currently pricing. But again, nevertheless, when they do start cutting, they'll probably be a little bit more aggressive, than maybe what they're forecasting. But when we look at, what the bond market is currently pricing, we're pretty much priced for a soft landing outcome. And that's the case, when we look at equity, we think that's the case when we look at equity valuations or riskier, credit, lower quality credit as well. So to us, when we think about longer term valuation of the bond market, it still looks good relative to your risky alternatives. Even though, from a near term tactical trading perspective, we could see, some of those cuts getting priced out. Of course, the path from here to there is never a straight one. It'll probably continue to be bumpy.
Yeah, I think that's the building consensus, which is trim your risk, bumpy ride ahead. Tiffany stays with us, Tiffany Wilding from PIMCO on her calls, navigating dissent. Let's turn our attention to tech. It could be a year of dissent in tech. Who knows? The Consumer Electronics Show is kicking off in Las Vegas, where the latest and the greatest in AI tech promises to dazzle. Ed Ludlow is on site. He and Caroline Hyde, I'm sure, will dazzle. Ed, good to see you. So Nvidia just keeps giving and giving this munificence. They're now going to help me. They're going to help me with an AI chip for my PC. But set the stage for us. Good morning, good afternoon.
Yeah, I mean, this is Nvidia's original competence. Good morning to you, Manus. I think the stock hit a fresh record Monday, a gain of 6% amid a broad rally in semiconductors. But the catalyst was their CES news. 3 new graphics chips for PC that allow for on-device running of large language models, generative AI tools. And Nvidia's argument has been that if you have the most superior chip in your PC running it locally, you have a greater security benefit versus running a large language model over the internet. And even though there was that broad rally, there's certainly evidence that the announcements they made at CES, where it's AI everything, certainly helped the stocks that fresh record, although I believe we pulled back a little now. There's also a really strong automotive presence here in Las Vegas. There is every year automotive technology. The piece of news out this Tuesday morning is Mobileye, the maker of chips for advanced driver assistance technology, is expanding a relationship with India's Mahindra, where it will put ADAS technology into Mahindra's next-gen cars. That's important because of the scale and size of India's market. Consumers there have been reluctant to buy higher cost premium cars, but it is the world's most dangerous set of roads, both in terms of death, collision, injury, and the dollar cost to insurers where accidents take place. I'm told by sources that this is a binding deal and it will be revenue generating. And I bring that up because you remember last week, Mobileye dropped the most on record, Jan 4th, because it gave a sales outlook for the year significantly below Wall Street estimates, where they expect sales in this current first quarter to drop 50% year on year. Why? All of their customers and the automakers that buy their chips and systems built up a backlog or inventories, so they've stopped ordering to work through them. But apart from that, here at CES, it's all about the weird and wonderful. We do expect the funky devices, and I'll keep you posted on what I look at.
Okay, Ed, thank you so much. I'm sure you'll bring those to us, and I'm looking forward to all the content from CES. Coming up, Capitol Hill, they're getting back to work.
House Republicans don't want an omnibus spending bill, so we have the January 19th date and the February 2nd date that we have to contend with, even if we have those spending levels. So that's the mission before us right now, and time is of the essence.
The House returning from recess, gearing up for a battle over the spending package. That conversation next on Bloomberg.
we are exactly where we were in June. The Freedom Caucus voted before Christmas, Kayleigh, to accept the Fiscal Responsibility Act spending levels. So I'm a little frustrated to hear that news today. What Speaker Johnson has before him with these levels is how will these spending bills come to the House floor? House Republicans don't want an omnibus spending bill, so we have the January 19th date and the February 2nd date that we have to contend with, even if we have those spending levels. So that's the mission before us right now, and time is of the essence.
Republican Congressman French Hill weighing in on the D.C. spending showdown, racing to a head as Congress grapples to avert a partial government shutdown. Now, both parties are using January 19 as the deadline to pressure their prerogatives. Ukraine aid for President Biden, tighter immigration policy for the GOP. Kayleigh Lyons is tracking all of this. Kayleigh, here we are. Will there be a stumble before they come to an agreement? I mean, are tensions mounting, or are we coalescing towards a deal?
Well, there very well could be a stumble, Manus. In theory, the top-line deal that was reached over the weekend was a good step forward. But as we were just hearing from Congressman French Hill, there are many conservatives who are not happy with that deal, would have liked to see deeper spending cuts or border policy measures included in this, which speaks to the idea that this still could hit hiccups in the 10 days between now and January 19th, where 4 different appropriation bills need to be passed in the House, the Senate, and signed into law by President Biden. The issue here is, A, that there could be conservative policy riders attached to these bills in the House to pacify some of those farther right members of the House Republican Conference on the part of Speaker Mike Johnson. Plus, you still have to divvy up that $1.6 trillion into each appropriation bill, decide how the money is going to be spent. And that work can be very difficult to do in such a short legislative span of time. 4 different appropriations bills needs to get over the finish line by January 19th to avoid a shutdown of those programs. The other difficulty here is whether or not a continuing resolution might be needed. That is something, a short-term kicking the can down the road that Mike Johnson has pledged not to do again. If he does so, that could get him into trouble. It could also get him into trouble if he were to pass appropriations bills with significant Democratic support, with content that conservative members of the House don't approve of. That could bring him basically to the same fate as former Speaker Kevin McCarthy, who, of course, lost his job late last year over passing funding-related bills with Democratic support. So that's the tricky line to walk here, in addition to border security measures that House Republicans are really pushing for, many of them saying H.R. 2, border security, or shut the government down, Manus.
Okay. Kayleigh, thank you very much. Kayleigh Lyons there with the very latest on the debt ceiling negotiations. Tiffany Wilding is still with us. When we talk about U.S. debt, we've gone through a number of asphyxiating moments last year, credit reviews, ratings reviews. You talk about 15-year yields at a 15-year high, creating an array of opportunities. But what is the fiscal risk here? Is that one of the imminent risks on the cards, or is that something that I look at in 3 years, 5 years? Do I just kick it into the long grass for the U.S.?
Yeah, well, I mean, obviously, I think that, understanding the point in time where the bond market really starts to get worried about, longer-term fiscal sustainability issues is obviously very difficult to forecast in any given year. Now what we would say is that the types of numbers, that Congress, is looking to pass for this year's government spending levels, will basically keep spending levels, a little bit higher than last year. On a nominal basis, but not that much. So, overall, we think actually spending and government spending in terms of its impact on the economy for this year, for 2024, will be much more muted, than some of the more, kind of the stimulative trends that happened last year. But nevertheless, the path of U.S. deficits that are projected as a result of demographics and some of the, the Medicaid, Medicare, the non-discretionary programs, that path obviously is unsustainable. Mm-hmm. And when we look to the election that's coming up, for example, this year, the likely candidates for, either a Biden or Trump, neither of those candidates in terms of what they're telling us, are really going to change that longer term trajectory. So of course, that's something that, Congress and the government is going to have to deal with at some point. When the bond market decides to really push them on that, obviously, is uncertain. But as a result, we like to maintain positions in our portfolio for a steeper interest rate curve. We think when investors look to increase duration, move out of cash, we think there's enough to do it in the intermediate sector, not go all the way out to the long end.
Okay, keep it in the short end and look for a re-steepening on the curve. Again, another consensus narrative that is building from the various bond guests. Tiffany, thank you so much. Tiffany Wilding there from PIMCO. Coming up on the show, market moving events that you need to watch on New Trader's Diary, right here on Bloomberg. Trading Diary, what you need to watch for the rest of the week. Wednesday, Fed speak. New York Fed President John Williams hits the tape, and it's the deadline for the SEC to vote on. You got it, that spot Bitcoin ETF. Please let it pass. And the next Republican presidential debate. Let's see what color comes from that. Thursday, you got it, inflation print CPI and another round of jobless claims. We round out the week on Friday. It is big bank earnings on Wall Street ahead of the opening bell. This was Countdown to the Market Open. John Farrell will be back. We have it on good authority. Not sure when. He will be back. This is Bloomberg.